34 years back, Nifty Index in 1991 was 326. It crashed but then recovered back up. In 1994, Nifty was 1385. Then it crashed 43%, but it recovered to new all-time high. In year 2000, Nifty was 1756. It crashed 51% and then it recovered up. In 2008, Nifty was 6288. It crashed 59% and still it recovered up. In year 2020, Nifty was 12,000. It crashed 38% and then recovered back up. Last year, Nifty was 20,000 and now it's near 25,000. Nifty is an algorithm, sir. A collection of stocks that gives privilege to only India's top 50 companies. Reliance, Adani, Tata, Bajaj, Aditya, SBI, all groups have their companies inside Nifty Index. The Nifty algorithm has a simple rule. If your stock price is growing and your business is run well, then you are inside the Nifty 50 stock list. And if your company is unable to compete and cannot keep growing in value, it doesn't matter who you are. Your company is out of this privileged list of top 50 companies. You can be DHF, Yes Bank, or even Anil Ambani, it doesn't matter. The algorithm is a strict rule which has enabled the Nifty Index to keep new high even after encountering so many crashes in past 34 years. Here we at MoneyDhan wanted to know exactly how many times has the Nifty crashed in past 34 years. How many days it took for Nifty to recover. What were the worst crashes and how much was the loss in percentage. If someone tells you all that information, you can be well prepared for the next crash, right? You will have knowledge of data which will help to keep your nervousness under check. The bleeding portfolio will not make you sweat. And who knows, this data might give you enough courage to add more money to the share market when it crashes. So let's begin. Whenever Nifty crashes, it can fall by 5% or 10% or even more than 20%. When our team at MoneyDhan investigated, we found that Nifty has crashed more than 5% and less than 10% multiple times in past history. Historically, the crash between the range of 5% and 10% occurred 27 times in past 34 years. Thereafter, between 10 and 20%, the Nifty fell 12 times. This means 27 times Nifty could not fall more than 10% from its all-time peak high. But 12 times, the Nifty Index has managed to fall more than 10%, but could not actually fall beyond 20%. Finally, our research team investigated the third scenario where Nifty Index saw a severe crash of more than 20%. And this terrifying crash occurred about 9 times in the past 34 years. Now, as a side note, some people find it tough to convert percentages into actual rupees. This is because we are not used to converting percentages into rupees in our day to day life. Let me help you out here. As you can see, when you hear numbers in percentages like 10%, tell this to yourself. For 1 crore capital in share market, 10% loss means 10 lakh rupees loss. Or if you assume an invested capital of not 1 crore but just 10 lakh rupees as capital, then 10% loss means 1 lakh rupees. In this video, we will be talking about crashes that occurred in Nifty which were more than 20% from its peak. There were in total 9 incidences where the Nifty Index crashed more than 20%. Unfortunately, whenever the Nifty Index managed to fall more than 20%, it has lost significantly high percentages. In my career since 2005, I have witnessed 2 of these 9 crashes. One was during the 2008 global financial crisis, when the Nifty Index fell 59% in just 9 months. Converting into rupee terms, that crash cost 58 lakh rupees of loss for every 1 crore capital. Then, the second crash which I witnessed was the more recent COVID crash of the year 2020, where Nifty fell 38% in a matter of just 8 weeks. Imagine losing 38 lakhs on 1 crore in just a few weeks. To understand the severity, let me share a quick example. Consider a person who invests 40,000 per month into a Nifty Index tracking mutual fund. It is widely known that the index have given a long-term average return of 12%. Every year this person invests 4.8 lakh, and in 10 years he has invested 4.8 multiplied by 10 equals 48 lakh rupees. On 11th year, his final balance due to the 12% compounded annual growth from Nifty is 1 crore. This person spent 10 years building this 1 crore corpus, and then he has to suffer a loss of 38 lakh in just matters of weeks is truly a nightmare. I hope you can imagine the pathetic situation of a person who lived through such a wealth destruction after giving 10 years of his blood, sweat, and effort. To make it brutal, this wealth destruction happened just when there was a need for this money in order to survive the global lockdown and job loss situation. Friends, again on a side note, financial experts like us are never excited even if a stock turns out to be a multi-bagger, which gives you a 1000% return. What bothers us more is when a stock falls even 50%. Let me show you a simple example. It will show you the devastating impact even a small crash can cause in terms of percentages. Percentages have a mathematical anomaly. See, if the value of a share falls from 100 rupees till 50 rupees, the loss is 50%. Same share from 50 rupees, if it has to go up till 100 rupees, the share has to double. The return is 100%, which is 2 times the 50% fall. This means if something loses 50% value, it must put 100%, which is double effort, just to get back to break even value of no loss and no profit. Now, coming back to the topic, let me zoom in more and try to explain how did we find out about the market crashes from the past 34 years of Nifty Index data set. Did you know the COVID induced crash of year 2020 lasted just 300 days? To know these facts, our SEBI licensed research team started off by finding the all-time high, also referred as peak for Nifty. Initially, we identify the peak value before which the crash happens. As you can see, we collected the data upon the COVID-induced crash that occurred in the year 2020. The Nifty peak was 12,362. This peak was made by the Nifty Index in the month of January 2020. Thereafter came that COVID crash. The bottom level was made at 7,610. This bottom was made in March month of the same year 2020. And from this bottom, Nifty recovered by going up. Question is, how much was the new peak? Nifty crossed its previous January all-time high and made a new peak by going up till 12,461. Next question we asked is, how much time did it take for the new peak to occur? We found that for this new peak, the investor had to wait until November 2020. Zooming out a little bit, we can now say that we have collected all the data. We noted down all the levels: the peak before crash level, bottom level, and new peak after recovery levels. Moving on, we started to count the days next. As you can see here, we tried to find how many days it took for Nifty to fall. The answer was 69 days from peak to bottom. There is a saying amongst investors, when the market falls, it jumps out of a window. But when it has to recover from the crash and go up, the market takes a staircase. Here, the sudden crash that occurred in just 69 days felt as if Nifty Index did jump out of a window. But the recovery days were longer and Nifty Index took 231 days to make a new peak. Total number of days from one peak to kiss the bottom and then to recover back all the way to new peak was 69 plus 231 equals 300 days. COVID crash occurred when the entire globe was shut down and took just 300 days to recover all its losses. This quick recovery data gives investors some confidence in India's growth story. Look at the screen. You have all those 9 crashes in front of you. Those crashes when the market fell more than 20% from its peak. Dot-com bubble crash occurred in year 2000. The total number of days this crash persisted was 1406 days. This was almost 4 years of waiting period. Second crash occurred in year 2010 when Nifty fell from 6,300 levels to 4,544 levels. It took Nifty 1,314 days to recover. Third biggest waiting period was 1,062 days. This was the infamous global financial crisis of year 2008. In past 10 years, we have witnessed two crashes which were more than 20%. One in 2015 and another in year 2020 COVID crash. While 2015 crash lasted just 753 days, COVID crash of year 2020 was much shorter at just 300 days. We recommend you to pause the screen, take a screenshot, keep this image laminated and paste it on your wall. Whenever the long-term investor in you have doubts, whenever you hesitate from investing during a market crash, look at the image. Let the data talk to you. When emotions cloud your judgment, data brings rational clarity. Now tell me an answer to an intriguing observation which MoneyDhan team has made. Every 5 years, the Nifty Index falls more than 20% from its peak. Since 2020 crash, we are yet to witness a 20% crash in Nifty. This year, do you think next opportunity will present itself? In conclusion, before you leave this video, you need to take away 4 points from this video. Market correction and fall are part of market cycles. Share market and real life have a lot of structural differences. Real life has a fixed pay system where you work 30 days, commit time, energy, efforts, skills, and then as a reward, you are entitled to monthly income. This is again not a bank fixed deposit where you lend money to the bank and in return, the bank pays you fixed interest. With a share market, you are taking a partnership in a business. Voluntarily, you are raising your hands up and becoming a business partner. You are volunteering to take all the downside risk in business and partner in all the upside profits that the business will generate. Thus, your investments will give results, and those results depend on whether the companies in the share market do well or do they perform badly. The returns will follow market cycles. This has to be accepted by an investor in you before entering into the share market. This is not a fixed pay system. Second point, in the long term, market always goes up. Historically, if a person keeps predicting a market crash every next week, he is bound to be right and correct once every 12 to 14 months. But if you keep saying the other way, if you keep saying that the share market will make an all time high soon, even that prediction will eventually come true every time. Historically, the data shows us that one must keep predicting an all time high in the share market and you will get that prediction correct sooner than later. Crashes should be taken for a short time fever. But markets will rise back again. That is a evergreen fact. Third point. When you are in the Indian stock market, the next 2 decades will belong to India for sure. We are a growing economy. Our population is young and they are educated and ready to serve global needs. We are not at war, and even in that worst case, our military and diplomatic position is getting stronger in relation with other neighboring countries. Fourth point is historical data helps us to understand the future patterns. Just now in this video, you saw the data and understood about the worst case crashes and recoveries that could occur in the Nifty Index. Moreover, you have a visual clarity about what news or events trigger the fall and how long the Nifty Index took to recover post crash. From data, we realize that the highest number of days where your money stayed in loss was 1400 days. But in recent times, with more participation from general public into the share market, the crashes last a shorter time period. Best example is the COVID crash of 2020, where the entire globe was shut and yet that market crash lasted just 300 days. Now you know the data, you have the money to invest, and unfortunately, you are out of choices since bank fixed deposit returns do not even cross inflation. It's high time to consult a SEBI registered investment advisor as an expert and get proper guidance before you do some financial blunder leading to loss of valuable time and money in the market. You are good at bringing capital to the table. A SEBI registered expert team like MoneyDhan is good in managing the capital you bring to the share market. We also say this to our clients. Look at the money you have like your own kid. The way you send your own kid to school for proper care and growth, hire us to help your finances to grow and nurture with minimal drawdown and mistakes. We take care of your capital like a teacher cares for kids in school. It's our work to monitor it, research about opportunities, avoid blunders, and enhance risk to reward ratio for your capital. Knowledge is available all over the internet. We help to act on it.